James, thanks for joining us. How did the Harmoney portfolios fare in February?
February was actually a pretty good month for the Harmoney fund range. The lowest positive absolute return was 1.8% for the Sterling Balance Fund. And we had a number of funds in the suite returning around about 3 either side of sort of 3% in local currency terms over the period. So decent absolute returns. Yep. Over 3 months, likewise, positive returns across the board. Clearly, they were impacted by January, which wasn't such a great month. And then over longer time periods, 12 months, all in positive territory, some double-digit returns, and 5 years since inception, all in positive territory.
So we've spoken about performance there, James. What were the main themes we saw in February?
Well, February started off quite weakly, to be honest, but the markets rallied strongly towards the end of the month, and once it was all said and done, over the course of February, global equities returned about 5% in US dollar terms. Emerging market at 3%, so again, not quite keeping up with the broader market.
Performance, yeah.
A little bit underperformance, and then the fixed income market's up about 1% over global government bonds over that period. Yeah. Credit did a little bit better. It's interesting, though, to note that of the 24 developed equity markets, all of them were up over the month in their own respective currencies, which is in the developed markets, which is a strong result. Yeah. And so it was really quite a broadly based month for positive returns. Yeah. That all pales into insignificance a little bit. As you know, at the time of producing this, which is early February, Russia and Ukraine are starting to experience issues over the Crimea, as you know. And so it serves as a salutary reminder, perhaps, that while we think valuation work is absolutely imperative over the medium and the long term, it informs us where to invest and what we expect to get in terms of returns. Clearly, in the shorter term, idiosyncratic risks like this are unpredictable inherently, and they can influence returns in the short term. So it's a nice example of why in the funds we don't have all the eggs in one basket. We don't back one horse, if you like. Yes. We spread our risk budget across a number of different potential outcomes in order to reduce our sensitivity to any one particular outcome.
In terms then, James, of the underlying assets in the fund, assets you yourself have put together, what drove performance in February?
Well, across the Harmoney funds, we've got a large range of asset classes we can choose from. Making that choice is in some ways less relevant in months like February, where sort of everything goes up.
Everything up, yeah.
Having said that, there were big differentials between what the equity markets did and what the fixed income markets did, for example. So asset allocation still is important to an extent. So the main drivers of performance for the Harmoney funds in February were roughly neutral to equities. So clearly we got that sort of tailwind to performance from the equity markets. We're slightly overweight emerging market equity, which would have detracted from performance because that particular subset of the world equity market did underperform the developed market. Yep. But again, it's relatively marginal given the size of these positions in the funds. On the fixed income side, we're very underweight government debt, and while government debt did add around 1% in US dollar terms over the month, that's clearly a degree of underperformance compared to the equity market, but also the credit market as well, which is where we tend to invest in the fixed income portion of the funds. So loans, investment grade credit, and emerging market debt, which is a reasonably new addition to the portfolio, is actually added to performance. EMD up nearly 4% over the month, which is a great return given what developed market government bonds have done. Elsewhere in the portfolios, we're overweight cash. In a month where most things go up, that's an opportunity cost, if you like. So that was a drag on the absolute return of the funds, but it's a position we're comfortable to hold on a medium-term view. Finally, underweight property. A month where property again underperformed the broader equity market. Property securities, important to remind ourselves. We were underweight there, and that benefited performance to an extent.
Good stuff. James, in terms then of how the Harmoney portfolio is positioned today and kind of prospective changes, could you just give us some details on that?
Yeah, of course. We've sort of summarised where we're positioned already. Just to recap on that, we're neutral to the equity markets with a bias towards emerging markets within that. So we're neutral to our home market, if you like, the global markets, and we're overweight global emerging market equities at the margin in the portfolios. Yes. Within the fixed income portion, we mentioned in the previous vodcast, we've cut our high yield exposure. Now we think that's got expensive, and there's an asymmetry in the returns that we find unattractive. Yep. But we have moved into hard currency emerging market debt, which we think looks very attractive from a total return perspective on a 3 to 5 year view. Elsewhere in fixed income, very heavily underweight government debt, overweight or neutral investment grade, overweight convertibles, and also cash, I suppose, if you think of it as a fixed income style asset. Yeah. We're overweight cash over and above government bonds. We prefer cash over government bonds today. Elsewhere in the portfolio, underweight property securities, but we mitigate that by having the infrastructure securities position in the portfolio, and then we've got the 1% position in gold mining stocks.
And finally, James, the outlook. What do you see going forwards? I know it's a very difficult time right now, but please give us your thoughts.
Well, I mean, on a 5-year view, a valuation-driven view, and excuse me for being quite boring in the sense that not much has changed over the last few months. We've taken a very circuitous route. But we've ended up roughly where we started, let's say 2-3 months ago. Valuations haven't moved sufficiently to change our view of the world. So we think that equities are about fair value, getting a little bit expensive, but still there's value there. Emerging markets cheaper on the equity side, hence why we've gone overweight there. Government bonds expensive, credit market more attractive, and that's the view that lives in our portfolios.
Yes.
Behind that, we think we're going to have a reasonable GDP outcome, reasonable economic outcome in the developed world. It's a slow growth environment, but it's a positive growth environment, and it may well accelerate, which again is a decent environment for the equity markets. Interest rates are going to stay lower for longer, but they are going to drift up. That hurts fixed income. We know that things like quantitative easing, other extraordinary liquidity measures are going to be withdrawn with time. And also we know that emerging markets, while we don't think they're going to collapse, we do think their GDP path is slowing. Having said that, we still think there's opportunities for investments in emerging market assets. So that's really our view of the world. That hasn't changed materially in the last couple of months. Clearly, again, the elephant in the room, though, is what's happening in Russia and Ukraine. It's inherently unpredictable. It's not modelable in any traditional sense. We can't trade around it. We can't use it as an opportunity to make sort of speculative gains, if you like. But it is a position we need to be aware of. We need to sort of watch it doesn't impact our portfolios too greatly. So the obvious area where it might impact us is emerging market assets. We've got emerging market equity, for example, in the portfolios. Russia's not a massive part of the emerging market index anymore. It's about 10% in round numbers. So Russia could be very severely impacted in terms of its market performance before it really affects the nominal outcome in emerging markets. There is a risk of contagion, and I think contagion means two different things in this instance. So it means one thing is, a risk of geopolitical spread, of sort of fallout more broadly. I don't think that's a problem for us today in terms of the emerging markets position. I think this is a reasonably contained issue as of today, as we're sitting here, 4th of February.
There we go.
It is still very early days, clearly. The other risk of contagion is one, it's much more of a sentimental one. It's a risk of people becoming averse, giving up, throwing in the towel when it comes to emerging market equities. Remember, we've had a period, the last 18 months, emerging markets have underperformed developed markets, and it's now quite an attritional position for a number of people. They're very much underwater with it. You've seen, we talked a little bit about nearly capitulation last year, people sort of throwing in the towel. This is a great example of things that actually make people just run away from the asset class and think, right, I've had enough. That might lead to some decent degrees of volatility in the markets coming forward, particularly again in emerging markets. We think there will be volatility that comes as a result of this. But again, bringing it all the way back to the bit we think we can predict with a reasonable degree of certainty, the valuation work we do, the 5-year forecasting, all things being equal, as of today, if emerging markets sold off aggressively, we would look at it as an opportunity to add to our positions because we think it's cheap. Now, clearly a number of different inputs on that or variables could change, but as things stand today, we would sort of welcome volatility in emerging markets, although it would hurt performance in the short term. We think it would give us an opportunity to add value in the long term.
James, thank you very much for joining us, and thank you for your insights.
Thanks, Richard.